Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Happy today to have Joseph Root. Joe, welcome to the show.
Hey, Brian, it's great to be here. Thanks a lot for having me on.
Yeah, going to be a lot of fun. And I mean, the listeners won't know this unless we say it, but we've already been talking for a good 20, 25 minutes already, and we probably should hit that go button a long time ago. But yeah, let's just do this and let's start talking about you. Tell us a little bit about yourself.
Well, I'm with East Superior Real Estate Capital. We are based out of Chicago. I've been in real estate since 2006. My family's been in real estate since 1983. So my parents were buying apartment buildings starting in the 80s. They had a property management company in Chicago that was pretty small, just managing a few buildings that they had, and they kept acquiring buildings.
Mhm.
I went to college out east and spent some time in New York City after college working in finance. Came back to Chicago to go to business school
Mhm.
in 2006. And while I was waiting to start over the summer, I sat down in the family office.
Mhm.
And it was a small office with a couple of property managers and real estate agents. I decided that I wanted to go to business school to get into private equity, to buy a
Mhm.
company and fix it. And then
Okay.
I saw this company right in front of me, and I said, there's a huge opportunity here to
Yeah.
streamline this business, make it more efficient, and grow. So my brother had been working there for a year. I decided to join full time for business school. We bought a building, and
Mhm.
then we had the great financial crisis.
Yeah,
And
I was gonna ask about that because when you said you started in 2006, I was just like all giddy with excitement. I'm like, okay, we're gonna have a lot of fun stories here. All right, so anyway, keep going.
Yeah. So we bought the building, our first building. It was a big investment for me. It's everything that I had saved up to that date. And I remember we had a loan coming due, and none of the banks were lending.
Hmm.
Luckily, we found a lender who was able to help us out and refinance that
Hmm.
property for us. So I don't have any battle scars from those times, although it was an interesting market. That lender who gave us that loan, they said, hey, you guys have a ton of property management experience. You've been managing properties for 20 plus years. We have some real estate that we're taking back into our portfolio. Would you be interested in helping us manage REO properties or take on receivership
Hmm.
accounts? And my dad said, I'm not interested in that at all. Maybe my boys are. And my brother and I said, yeah, well, let's do it.
Nice.
So we started taking on receivership counts. We had about 150 receivership cases over 4 years.
Hmm.
Managed a big part of the Merrill Lynch portfolio that came out that a private equity firm in California bought, and did a bunch of receivership cases for local regional banks here in
Hmm.
Chicago and Illinois.
Okay.
So
And
that
in layman's terms, I mean, that's properties foreclosed by the bank, correct?
well, when somebody defaults on their mortgage,
Hmm.
the lender has the right usually to have a
Hmm.
receiver appointed. And a
Okay.
receiver is appointed by a judge, and the receiver basically becomes the property manager
Hmm.
while that property is in the foreclosure process. And that
Hmm.
foreclosure process can take 6 months to a couple of years.
Right.
So the lender wants to know that that property, that the rent that gets collected is
Mhm.
maintaining the property and not going into the person's pocket who's defaulted and maybe not paying their loan anymore.
Okay, got it. I see the reason for that because I mean, once you've defaulted on a property and you know you're going to foreclose, I mean, is there any reason to keep the income going to the property? So the receivership is to protect the lender's interests, and so you guys take control, or you guys are managing the property and making sure that the money in is actually staying in the property at that point, correct?
Yep, pretty much.
Got it.
A lot of properties we got involved in, they had not been maintained. So there
Mhm.
was a lot of deferred maintenance because some of those
Yeah.
borrowers knew they were in trouble.
It's kind of like human nature. If you know you're going to give a property back to the lender, are you going to be dumping a lot more money into the property? Probably not is the answer. So
Yep.
cool. Awesome. All right, so let's go from there. So you guys were doing that for a while. Court appointed you guys as the managers. I don't know the technical term for that one, but let's just move on from that one and kind of go into what happened next from there.
Yeah. So, well, that was our foray into fee management. Before
Mhm.
that, we'd only managed the apartment buildings that our family owned.
Mhm.
We had a pretty decent portfolio in Lincoln Park and Lakeview in Chicago
Mhm.
of mid-size apartment buildings.
Mhm.
But that was the first time we managed something for someone else. And when the receivership started to wind down, we decided that we were going to become a fee management company. And the name of this company is Root Property Group.
Mhm.
So the firm I'm with today is East Superior Real Estate Partners, and Root Property Group is the property management company that we're affiliated with. So my brother and I then decided to start building out a fee management business, marketing those services. And over that period of time, I actually did go back to business school and got my MBA from Northwestern. And we grew the business quite a bit over the next 4 years. We ended up being in the Inc. 5000 twice for fastest growing private companies in America.
Nice.
And we got a ton of experience managing buildings, renovating buildings for other people. And my brother and I had bought a few buildings along the way. We weren't really thinking about scaling as an investment business.
Hmm.
So in about 2014,
Uh-huh.
we realized we'd learned a lot. We decided to start asking our friends and family. We said, hey, we've got all these resources. We can
Hmm.
renovate buildings, we can rehab buildings,
Yeah.
we can manage buildings, we've got maintenance people, we've got leasing agents, we can create a ton of value. Would you guys want to invest with us? And our
Mhm.
friends and family were happy to do that. And so from 2014 until about 2022, we bought a number of buildings. I think we've had about 28 investments.
Mhm.
And we've had some spectacular returns over that period of time.
Mhm.
And we continued kind of growing and scaling into larger properties.
Yeah. So what did that growth and scale look like? I mean, let's talk about kind of your progression with the properties. What first couple of properties you bought, what do those look like? And then, how did you scale up into to where you guys are at right now?
The first couple properties we bought were probably three flats.
Hmm.
And well, actually, the first property we bought in 2006 was a large mixed use
Hmm.
creative office space with apartments upstairs in a really kind of hip neighborhood in Chicago. We still own that building today. We were never really in the mindset of selling property. We always liked to own them and keep them.
Yeah.
So that one is still in our portfolio. But then after the great financial crisis happened, we kind of started small again and went and bought a couple three flats, fixed them up, and realized that we could refinance and get our cash out and then buy something else and do it again. And so it was kind of a rinse and repeat for a couple of years until at some point we thought these three flats they're not that interesting. Let's try to do a 12 unit building.
Yeah.
And,
Okay.
and I think it was because we realized we were putting a lot of time into the three flats. They were working, it was successful, but it probably wouldn't be that much different to do a larger building from the amount of time that it took us to buy the deal,
Mm-hmm.
fund the deal, renovate the deal. And we had the resources because we'd been scaling the management company. So we started getting into bigger properties like 12 units. We bought a 28 unit building with our friends and family and a 30 and a 33 unit building. So that's kind of where we topped out with the friends and family. And it happened pretty quick. I think it was the three flats to the 12 flats to the 30 unit buildings all happened pretty quickly once we realized that we can get into a bigger deal. It's not that much different. The processes, our due diligence, our management is all very similar. And
Mm-hmm.
so the incremental effort and smarts wasn't that difficult for us.
Yeah, I mean, going by increments, there's different philosophies, and I think there's merits to, each different path, but the incremental, I think, is a lot safer, going from 3 to 12 and 12 to 24. Some people will say if you want to end up in large properties, go from 0 to 100. There's merits to both sides, but I think, going from the 3 to 12, especially if you own the property management company already, I think that's like very, very safe, very secure. You're not going to lose money. I think is how that works. And if especially with that long-term hold, I think you guys have a really, really good, solid way of moving forward, and your investors probably appreciate that. Are you still in that range, the 20s and 30s, or have you guys gone bigger, or are you looking to go bigger, or what's your strategy from here?
Yeah, we're still in that range. We like to invest in Chicago.
Hmm.
We also like the greater Midwest. We decided that we wanted to move up from the 30 unit size buildings, and we thought maybe we should expand into new markets.
Hmm.
And so I went down to a conference in Miami a couple of years ago and heard about the 3% cap rates that people were paying. And I heard a lot
Yeah.
of people, they laughed at us for liking the Midwest and investing in the Midwest and in Chicago.
Yeah.
And I came back from that and I thought, the Sun Belt is flashy and everybody wants to talk about it and there's growth there, definitely. But
Hmm.
it seemed to me like a venture investment
Hmm.
where you're just banking on growth and appreciation. And some of the opportunities that we were seeing in Chicago and the Midwest seemed more like value investments,
Hmm.
where we could buy a property that would cash flow and improve it. And so we could increase NOI while having that property appreciate and cash flow all at the same time. And so we had a partner, an advisor come in, and he's a data scientist, and he built us a machine learning model
Mhm.
that we took a bunch of data and fed into it, and he trained it, and we had it predict rent over the next 3 years.
Mhm.
And what it told us was that the top few markets in the country would probably be in the Midwest. And this was
Mhm.
back in 2022. So,
And for rent growth, you nailed it. I mean, because
yeah,
yeah, I mean, a lot of the southeastern, like a lot of the Sun Belt, are seeing negative rent growth. And if you look where rents are still going up, it is Midwest markets. So, wow,
it's
good for you guys for predicting that.
we predicted it. Our vision is we want to expand throughout the Midwest.
Hmm.
We like Wisconsin, we
Yep.
like Michigan, we like parts of Indiana, and we've looked at some things in Iowa. We believe that there's still solid job growth in
Hmm.
those markets, and there's not a lot of supply getting built. So we have a chart that we like to look at, and this is a Chicago centric chart, but it kind of shows units under construction in some of the markets like Nashville and Austin versus their vacancy rates. And those markets have a huge percent of their units under construction and high vacancy rates. And then we look at Chicago, Milwaukee, Cincinnati, and Chicago has 2% of their units under construction and a 96% occupancy rate.
Yeah.
So to us, we said, okay, the supply and demand in the Midwest seems pretty solid. And in some of the other states and cities that we looked at, we thought it would take years for the rents to catch up to all the supply that they had.
Hmm.
So that was our thesis for Chicago and the Midwest. We're still looking to expand when we go outside of Chicago, which we actually have not done yet. That's our next move. We think we have to buy a minimum size building because we want to be able to put our property management staff out there because we've invested a lot in building a property management company that's built on technology and resident satisfaction. We like to say that we're bringing institutional level management to mid-market properties. So we've sort of figured out how to make people feel like they're living in a very luxury place and really enjoy their experience living in our properties. The magic to that is sort of in our Chicago office with the technology and the staff that we have here that
Yeah.
runs.
And that's a tough nut to crack. I think I mean most of the properties that I've owned are kind of in that double digit range, and so trying to have institutional management on those smaller properties. Let's dial into that. And I think a lot of people who are coming into the game, that's where their first couple of properties are going to be. So how do you kind of solve that problem? You mentioned technology, you mentioned Chicago office. Can we dive a little bit deeper into how to bring better management to the kind of like that 20 to I would call it like that 20 to 75 space, where it's kind of like in that gray zone of managing.
Yeah, that space where you don't have an on-site manager.
Exactly.
That's tricky.
Exactly. It's big enough
Um,
where you need an on-site manager, but not big enough to be able to afford it. And that's the
right.
space. Yeah. How do you effectively manage those?
Yeah, we call it scattered site management.
Hmm.
In Chicago, that's the hub that we have, and we manage properties all around Chicago, the north side of Chicago and suburbs. We have sort of been tweaking the model for years. A property management business is pretty complex. There's
Hmm.
lots of things going on all the time. There's resident issues unrelated to maintenance. There's
Yep.
maintenance issues. There's leasing. There's routine maintenance. There's bills that come in
Hmm.
that have to get paid. So what we did is we started a centralized hub
Hmm.
and we have built out some technology like for example we have an AI that we built that can sync into our system and someone can call or talk to them online and it can answer questions about their leases or move out dates or if they have an issue they can talk to it and it will send that issue on to the appropriate person who can direct it to maintenance or a property manager for them to get in touch. We have processes for how our employees are compensated that
Hmm.
have to do with resident satisfaction
Hmm.
and also keeping the property NOI within budget. Our staff is sort of bought in and aligned with us on that. I mean, we have a great team on the property management side, and we have somebody who runs that business today, and
Hmm.
he spends a lot of time working on figuring out the right KPIs to
Hmm.
incentivize our maintenance people, our leasing agents, and our property managers to keep our
Yeah.
residents happy while at the same time keeping those buildings efficient. And so he does a terrific job at that. But I think that's really the magic.
Yeah, I love that concept, and it's something that we've been talking about internally. We're using third party property management companies, And I mean, just the compensation package, we've seen what our property managers are giving our on-site staff as far as bonuses, and it doesn't quite align with what we want them to do, which is kind of interesting. But and so you say you guys you're coming up with specific KPIs for your employees, and so their bonus package and their compensation package is based off the KPIs that owners want to see.
Exactly.
Awesome.
Owners and residents. I mean, we think that a happy resident makes a happy owner. So one of our biggest line
Tom, that's
items on any
true.
property is
Yeah.
turnover, and
Yeah.
our renewal rate is really high, while our renewal our rent growth is also
Yeah.
at market or above. So
Good point with resident satisfaction. I mean, our biggest cost on the maintenance side is turns, I mean, that's when we're spending the most money is, somebody moves out and you go in and you're spending a lot of money on those turns compared to anything else. And so if you can eliminate a churn, if you can keep a resident, you don't have that 2 to 3 weeks of, vacancy. You don't have the turn costs. Yeah, you keep happy residents and usually that makes happy owners too. So of course, residents are a lot happier when they're paying less too. So there's kind of a balancing.
that for
But
sure.
yeah.
But I think that those learnings have really influenced the investment side of our business, the eSuperior business, because we have now basic turn packages. So we have renovation packages. We also have turn packages. And so we have a warehouse full of materials that we're stocking that we can get a unit turned really quickly. Sometimes we can have someone move in the day after someone moves out, and that unit will look like sparkling new. And we also have kind of figured out, we look at the certain demographics in a neighborhood or an area where we're buying a property, and that will influence how we value the unit mix. So based on the demographic, the age, the income levels, we might want 1 bedrooms, or we might want 2 bed, 2 baths, or we might want 3 bed, 2 baths. Have kind of figured out which demographics tie to the longest term tenants in those types of units. So that kind of data that we have from our just years of experience on the management side can help us really predict our unit turns and our renewal rates.
Yeah, yeah, and that's huge. I mean, being able to get that, I mean, that's half the battle right there. So, what I think is really interesting about how you guys are doing it is it's kind of like the opposite of what most people do. I mean, most people start buying properties and then bring their management in-house. You guys started with management. I don't think I'd recommend that for somebody to start with the management company and then buying properties, but you're taking your lessons learned from a property manager and applying them to multifamily ownership, which I think is awesome. Yeah, I wish I had your level of experience in property management to be able to apply to what I'm doing right now. So a little bit jealous is what I'm saying, but
Yeah, well, it's helpful, but it was a lot of sweat and hard work to run a management business. So
yeah,
I agree with you. I wouldn't recommend someone start the management business.
yeah,
For us, we were kind of born into it, managing our family portfolio, and so
yeah.
it was just natural for us to scale from there.
I think you said your family had been in real estate since the 80s. So 83, is that what you said?
83, yeah. So
83.
we had our 40-year anniversary party a few years ago. It
Awesome.
was a big
Awesome.
deal.
Yeah. So, well, cool, cool, cool. How about this? You talked about buying properties that meet a certain threshold. Where's your line in the sand for unit size or unit count? Or you guys use a different metric? So when you talk about buying properties outside of Chicago, where it kind of makes sense for you guys with management, where is that line in the sand?
Yeah, that's a good question, because we don't think of it as in terms of unit count. We think of it in terms of asset value.
Okay.
And we kind of draw the line in the sand at 10 million is the minimum for us to put some staff into a new market.
Okay. Now, let me ask one more question. Why do you choose asset value and not unit count? Just curious on that one.
It's because we think of the asset value is going to tie to a gross
Mhm.
rent multiplier. So we kind of have a sense of what the rent will be if we buy a $10 million building. And with that, we have a sense of what the management fee will be.
Mhm.
And we like our management fees are pretty low. We're kind of just for our properties, we're managing at cost because we're trying to pass that efficiency on to our investors. And so we know this property is going to generate this much rent, and that's going to support one manager who's also working as a leasing agent, and we can put that person on site and it'll be cheaper than hiring a local manager.
Okay. Yeah, that makes sense. That makes sense. So when you look at, I'm just kind of recapping. So when you look at the property value or the purchase price, that is what most directly correlates with income coming down and whether or not it will support staff.
Right. And we kind of play in what we call high credit markets.
Mhm.
So usually we're buying property that's got a higher price per unit, and so the rents are higher. So sometimes our like we talk to certain investors who say we don't want anything less than 100 units because you can't have management there. And we said, well, actually we can because the rents would support a couple of people.
Yeah.
We're in higher rent markets, neighborhoods.
Yeah. I think when you look at unit count, I mean, I've owned properties in several different states. I think, in like South Carolina, where I've owned a lot of properties, there's a kind of a higher threshold for that on-site management if you're just looking at unit count versus Salt Lake. Salt Lake City, we're paying almost 2 to 3x, what the price per door per South Carolina. So I would kind of draw my line on the sand in unit count in Salt Lake at like 75, but in South Carolina, it would have to be over 100. So I think that probably does work into values as well. But I've kind of looked at it more as unit count, but realizing that each market has its own threshold. But you guys are looking at purchase price and saying, hey, if it's above 10 million, it makes sense for us to manage this. If it's below 10 million, I like that. I like that. Just a different way of thinking about the same issue. So you guys are looking for properties above 10 million Midwest now. What else are you guys specifically looking for? I mean, you mentioned that you guys have the capability to do value adds. So are you guys looking for value adds or looking for something else?
Value add has kind of been our core business, and we've done everything from heavy, like gut renovated, taking things down to the studs and built them back up, to just real cosmetic, putting in new cabinets and appliances. What we're seeing today is actually, we've been seeing for the last probably 18 months, is that on the heavier value add,
Mhm.
the risk versus return is not really there for us.
Mhm.
And so what we're seeing is as most interesting with the best, what we think about as a risk adjusted return is newer vintage product that you can usually buy below replacement cost and needs a light upgrade,
Mhm.
maybe cabinets, maybe just updating the common areas, and then just better management.
Mhm.
We're seeing like some developers out there who've had things for 10 years and they're managing themselves and they're just not really
Yeah.
optimizing the NOI on that property. And
Mhm.
so we think that we can go in and do a real light update,
Mhm.
increase the efficiency of the building, and that'll get us kind of the returns that we're looking for. And it doesn't
Mhm.
require the heavy lift that some value add does.
That's kind of like the space that I like to operate in myself. In the lighter value adds, there's a lot of bonuses that I look at. Like, for example, when you're doing a lighter value add, you're typically keeping your occupancy at or above 85%, which means you've got a lot of money coming in. And something else I very much appreciate with the light value adds is a lot of times you don't have to do permits. If you're replacing something, you don't have to deal with the city, you don't have to get permits. When you're doing heavier value adds, there's that extra kind of layer in there that you have to get a lot of the stuff permitted. That's kind of like why I like them. And I think you're right. A lot of things you hit nail on the head. There's a lot less risk when you're doing the light value adds because, your scope's smaller and you're still getting a fair amount of return from it. So actually everything right there is right in line with exactly what I do. So
I,
yeah, boom.
I I had somebody ask me once, they said, why is the heavy value add riskier
Mhm.
than a cosmetic value add?
Mhm.
And their thinking was you're adding more value by doing the heavy value add, so it shouldn't be as risky. And I thought about it a little bit, and everyone says it's riskier, and there's a lot of reasons actually. But one of the biggest ones is execution risk.
Yeah.
So we have had properties where we've gotten construction loans. So we take
Mhm.
out a loan that's got 18 to 24 months of term. The interest is accruing. You're not paying interest on it while you're borrowing. You're drawing that out of an escrow account. You have no rent coming in because you have no tenants in that building.
Mhm.
And if you
Yeah.
don't execute that project in a timely manner, you're going to have a ton of interest pile up,
Yeah.
and you can also run out of time.
Mhm.
And those are major risks.
Run out of time, run out of money. Both of those are going to kill your deals. So,
Run out of money. That the first construction loan I got, the lender said to me, Joe, you need more money, borrow more. And he said, the worst thing that can happen to you is you don't borrow enough on a
mhm.
construction project.
Yeah, we were doing these lighter value adds, and so when I look at what's worst case scenario on the lighter value adds, if you buy 100 units and you run out of money, you renovate 80. Is that a catastrophic failure? No, it's not, you know. But if you're doing like these heavy lifts and you run out of money, I think you're right. That execution risk right there. That's how I look at the risk is what happens if you run out of money, what happens if you run out of time. If you're doing a heavier value add and you can't put tenants in there, that's a really bad end state. So,
I've bought property from people in that situation.
mhm,
Probably about 7 years ago, we were buying property where the developer, renovator, rehabber ran
yeah.
out of money and couldn't finish the project,
Mhm.
and their note was coming due, and we were able to
Yeah.
take them out.
We bought one like that about 6 months ago. They actually did take everybody out of the building, you know, and so a little bit more extensive of a value add. They did a full renovation, but they did run out of money and they did run out of time. But fortunately, you know, they were able to release it out and get everybody in. They had kind of like this inside out approach on the renovations and they didn't get to the outside. And so, you know, where they stopped was a lot of the exterior things that if I were doing a renovation, I would have planned to do all the exterior stuff as well. But I mean, they got to the point to where they could occupy it, you know, legally, get the certificate of occupancy. But yeah, they did a little heavier value add, and we were beneficiary of that because, you know, we were able to buy the property at a good price and still add value and now be able to hold it. So yeah, I mean, lots of ways to make money. But anyway, we are almost out of time. So a couple questions to end it. We already talked about what's next for you. That's typically one of the questions I close with. And we've already kind of talked about your game plan. So I'm going to skip over that one. How about this? What advice would you give to somebody who's entering the multifamily space right now as a first timer?
There's a lot of advice I'd give them. I'd say keep it simple, focus on a market that
Mhm.
you understand. We're maybe a little too conservative and haven't expanded outside of our markets as quickly as we could have, but we really want to understand any market that we're going into. And data is a big thing for us. We want to understand who the tenants would be. But something that you just mentioned on that renovation project, I think is huge. We look at buildings sometimes where people say it's been renovated or it's 80% of the way renovated. And we go in and we say, okay, they did all the work to make these units look nice and maybe get better rent,
Mhm.
but the roof is 30 years old. The basement there's cracks everywhere. The windows are old and the plumbing doesn't have enough electric power for what people want today.
Mhm.
And so we really love when we see a building that has all those mechanicals updated, even if the units are not updated. That's the ideal building for us. Updated mechanicals. And so I would
Yeah.
just tell people look out for that. Like
Yeah.
that stuff is really important. It doesn't increase your rent, but it's
Mhm.
really important.
Yeah. There's lots of things that fall into that category. I mean, I've fixed a lot of asphalt. You know, it does affect your curb appeal and it affects rentability and everything else, but it's hard to, you know, dump $100,000 into asphalt and show where it increased your rents, you know. But I agree. For people who are starting out, don't tackle all of that at once. Leave that for other people. But
Yeah.
all right, last question. How can listeners learn more about you?
You can go to our website, which is esrepartners.com, or you can look me up on LinkedIn, Joe Root, East Superior. I'm in Chicago, and happy to chat with anybody if they ever want to talk.
Awesome. So we'll put that in the show notes. And for everybody listening, you know, if you're interested in reaching out, reach out. And well, Joe, hey, thanks for coming on. Thanks for all the value you provided.
Hey, you're welcome, Brian. It's a pleasure to be here. Thank you for having me.
Absolutely.